after we prepare the adjusted trial balance and we've ensured that our credits and our debits are equal, then we'll move on to preparing the financial statements. Okay, so what we're going to do is we're going to prepare the financial statements, and we're going to prepare them in a very specific order, right? First step, statement of income, your income statement. It's the first one we create. Then we do the statement of stockholders' equity, or the returned earnings statement. That's what I always call it. And then your balance sheet, and then your statement of cash flows. We're going to prepare them in this order, right? This is just kind of a reminder of why we prepare those in this order. So you're going to prepare your income statement, and from your, well, technically first your adjusted trial balance right here, and all of your information from that is going to go to our financial statements. So we'll take the revenues and the expenses, and we'll put those into our income statement. We'll take the we will take the assets, liabilities, and equity. That'll go to your balance sheet. We'll take the net income. That goes to your retained earnings statement, and then your ending retained earnings balance goes to your balance sheet. It's all just a flow of information, right? And then the statement of cash flows is always separate. It does contain items from some of your other earning or your income, it contains items from some of your other financial statements. So net income from your income statement. Then you're going to have your ending cash balance that comes from your balance sheet. This, again, remember, the statement of cash flows is just a complementary statement that we prepare. Okay. So the next thing we got to talk about is the closing process. Now, I think the closing process is probably a little easier than the adjusting entries that we've talked about, because really what we're doing one thing. We're closing what we call temporary accounts. You can also call these nominal accounts, okay? This is how accountants are going to refer to it, okay? This is the accounting term. When you hear accountants talk about temporary accounts, they're going to say they're nominal, right? But be familiar with both of these terms. So temporary account, all that really means is that we're going to close it at the end of each accounting period, okay? This just means we're going to make it equal 0. So if we report every month, if the month is our accounting period, we're going to make these accounts equal 0. So what are these temporary accounts? How do we know when it's a temporary account? Well, if it's a revenue, an expense, or a dividend, okay? So it is your income statement accounts they are temporary. They get closed, okay? So your income statement accounts plus dividends, okay? They get closed. So what we're doing is we're going to reduce these account balances to 0, and we close them to retained earnings. So, like if we think about it, we have retained earnings, right? This makes sense. We have retained earnings. Retained earnings is made up of net income and dividends. Well, how do we make up net income? It's revenues and expenses, right? So these are all just getting closed to retained earnings. So every month, we start over at 0, right? So revenues increase equity and increases retained earnings. Expenses decrease equity and decrease retained earnings. And dividends decrease equity and decrease retained earnings, right? So all of these things are just being closed to retained earnings every month. The beginning balance is 0. Okay? And we make sure that's true by closing the accounts. So what is the closing process? Well, permanent accounts, okay, anything that we call a permanent account, including retained earnings, are on the balance sheet. So anything on the balance sheet is a permanent account. That's your assets, your liabilities, and your stockholders' equity. These are permanent account balances, and they do what we call rolling forward. So if you have $1,000 in assets at the end of 12/31, then on 1/1 you're going to have $1,000 in assets. Okay, they roll forward to the next period. This is an important key. I should probably just address this again. I know I've told you guys this before, but the ending balance for your prior period is the beginning balance for your next period. Okay, so your ending balance becomes your beginning balance. Okay, so let's review how to increase and decrease those temporary accounts. Now remember, those temporary accounts are your income statement accounts. Your income statement accounts plus dividends, right? Because we have to close dividends out to retained earnings as well. So how do we increase and decrease those temporary accounts? Well, revenue, we are going to increase it with a credit, right? Remember, let's just think about our DEAD acronym here, okay? So debits increase expenses, assets, and dividends, okay? Well, we've got one here, revenue, that doesn't live in this, so we increase with a credit, we decrease with a debit. Expenses is right here, it's the E in your DEAD. So we increase with a debit, and if we want to decrease it, in this case we're closing it, then we credit it. Same thing with dividends. It is the D in DEAD, the second D in DEAD. You increase with a debit, you decrease with a credit. Okay, just a quick review on what we do with those accounts. Okay, to close these accounts, revenues, we want to close it to retained earnings, we close it with a debit. Okay, close to retained earnings with a debit. Expenses, we close to retained earnings with a credit. Dividends, we close to retained earnings with a credit. Why is that? Well, let's look at revenues, for example. Let's look at revenue as a T account, right? We increase on the right, decrease on the left. Let's say we've got $5,000 worth of revenue, and we need to make this equal zero. At the end, the ending balance needs to be zero. How do we get there? Well, we have an X on this side, right? So we know we need a minus $5,000. It's going to be on the left side. The left side is debit. So we close revenues to zero to retained earnings with a debit. Same thing with expenses. What does an expense account look like? Well, it looks like this, right? So if we have $1,000 in expense and we want this to be zero on the ending balance, we know we need 1,000 minus 1,000 to get to zero, right? So we're going to credit it by 1,000. Okay, so we close with a credit. And dividends, you could just change out this expense to say dividends, right? Because they both hold the same debit normal balance. So any questions on that, feel free to contact me. We will move along with this concept in the next video.